Good evening, everyone. On behalf of NISM, I welcome you all for today's webinar on technical analysis. I am Neha Deshmukh, working with NISM. Joining us are today's esteemed speaker who will be leading this session. So before we start, let me brief you about NISM and today's topic. NISM, the National Institute of Security Market, is an autonomous institute established by Securities and Exchange Board of India to promote education and research in the securities market. It offers various certification programs for professionals in the financial market to enhance their skills and knowledge. NISM also conducts examination and provides training program to ensure regulatory compliances and professional development in the security industry. For more details, you can visit nism.ac.in. So let me brief about today's topic, which is technical analysis. Today, we will discuss some of the most common Japanese candlestick pattern used in technical analysis, including the hammer, hanging man, doji, and engulfing pattern. So it's my honor to introduce our today's speaker, Mr. Vijay Kanchan. Sir has hold a master degree in finance from JBI MS Mumbai and has earned multiple NISM certificate in areas such as equity derivative, currency derivative, interest rate derivative, fixed income securities, and research analysis. Additionally, he has obtained a certification in alternative investment from IIM Bangalore. In his professional experience, Sir is a highly experienced capital market professional with nearly 30 years of expertise across various domains, include derivative strategies, institutional dealing, depository operation, and proprietary trading. He has a leadership position in institutional derivatives at renowned firms such as JM Finance Limited, Dolat Capital Market Limited. He has conducted numerous continuing professional education training programs on behalf of organizations such as NISM, NSC, BAC, CIEL, AAFM, and successfully training over 10,000 market participants. So without any further delay, let me hand over the session to Sir. Over to you, Sir. Welcome, Sir.
Yeah, thank you, Neha ma'am, for that kind introduction. Good afternoon, everyone. Are you able to hear me clearly? Can you please respond? Okay. So without wasting much time, I'll just share my screen with you. Please confirm whether you're able to see my screen.
Yes, it is visible.
So this is going to be the flow of the presentation. I'll give you a brief introduction to technicals and what charting is all about. We'll have a look at a few basic chart types. Then we'll have a look at both the single candlestick, how to look at the candlestick for a given day or for a given period, and then you look at multiple candlestick patterns like a two candle or a three candlestick type of a pattern. Some commonly used patterns in the market like your hammer, dojis, hanging man, engulfing patterns, etc. Finally, if time permits, we'll cover a little bit of triangles and then we'll have a question and answer session. Okay. So let me begin by explaining what technical analysis is all about. So there are two ways in which investors, traders, professional traders try to play the market. So one is by looking at the fundamental data, and other is looking at the technical side of the market. Technical analysis has got nothing to do with fundamentals. It has got nothing to do with balance sheet, the macros, the profit and loss, the cash flows, etc. So it only looks at the price action. It tries to identify demand and supply in the market, and basically it is a study of how prices have behaved historically, and there is one underlying assumption here that history repeats itself. So basically, a chartist, a technical analyst, who's also called as a chartist, he focuses on the study of past market data, basically price and volume. So there is no effort here to find out the intrinsic value of the stock. Unlike the fundamental analyst who will do a series of what you call analysis and calculation, and he tries to find out the correct price of the share. Nothing like that happens here. Yeah, basically what the chartist is trying to do is uh, gauge the market sentiment, the market mood, and tries to find out whether the market is likely to be bullish or bearish. So we all know that in the long run, the fundamentals work. The price of the stock is basically a function of its operating performance, its profitability, sales, etc. But in the short run, it is emotions which drives the market. So what the chartist tries to ascertain is he tries to understand the emotions in the market by studying the market action. So they use a series of indicators, chart patterns, etc. By itself, it's a very vast subject. It's an ocean. It's not possible to cover everything in 1 hour. So what we will do is let us have a look at some of the fundamentals, some popular charting pattern, and once we end the session, we will take some few common questions, and that's how we go about it. So at a very basic level, it is a study of market action. Basically, what we are doing is recording the price information in a graphic form so that we the visual impact that we are trying to capture, it is so good that just by looking at the chart, we are able to know what is happening in the market. Uh, so two things matter, the price and the volume over time. So this is what essentially captures the demand and supply in the market. So technical analysis is based on the study of these four things: the trend, the price, the volume, and all these over time. So when we look at the markets, basically the markets has three stages. Uh, it could be upwardly trending, it could be downwardly trending, or it could be moving sideways. Uh, in other words, an upwardly trending market is what we commonly call as a bullish market. A downwardly trending market is what is referred to as a bearish market. And a sideway market is a market which is largely range bound. It's going nowhere. It is moving within a narrow range, sometimes going up, sometimes going down. Uh, it is said that the market price discounts everything. Like in Hindi, they use a term, bhav bhagwan hai, means the price captures everything. So a hardcore technical analyst really does not believe in the fundamental side of the story, because he says that everything is reflected in the price. Price is supreme. So any good news, historical news, any forthcoming news, future news, everything is there in the price itself. So the price captures everything, or in other words, the market price discounts everything, every possible information that is available in both public and private domain. Price normally moves in trends, unless the market is sideways, but then the markets do not remain sideways for a long period of time. Eventually, it would take a trend, either an upward trend or a downward trend. And one of the fundamental assumption of technical analysis is what has happened in the past is likely to be repeated in the future. So history repeats itself. Let's have a look at the chart. What exactly is the meaning of a chart? So chart, we represent the price and volumes over a period of time. So it's a two-dimensional representation. Uh, on the x-axis, you will have time and volumes, and on the y-axis, you will have the price. So this is how it looks like. Okay? Uh, we normally have some four chart types or chart patterns. So one is a line chart. Line chart is very easy to understand. I will show you how it looks like. Uh, but the problem with line chart is you do not know the activity which has happened during the course of the day. So you can only have the opening price or the closing price or the weighted average price. So you have to choose your price. So typically, when you draw a line chart, you are going to favor one price point over the other. Uh, it's very simple to draw, very easy to understand. Some people prefer using the line chart. Let's go to the bar chart. Slightly more difficult than the line chart. At the first shot, it is not so easy to understand. It captures the opening price, and in a lot of software you will see this. It's very good for the classical patterns. It's very good for display. I'm coming to the third one, which is the candlestick. Uh, Sometimes also called as the Japanese candlestick, and we're going to study a little bit more about this today. Uh, it's the candlestick holds a lot of information. You need the opening price, you need the closing price, you need the high of the day, you need the low of the day, and it comes with its own color. So if the prices have gone up, I mean the closing is higher than the opening, and normally the candle would be a green candle. And if the prices closing price is lower than the opening price, the candle would be a red candle. So it tells you what has happened uh, during the day. There is a lot of information which is there in the candle chart if you know how to analyze it. Point and fingers are normally not so much used in the market. It is said that it is good for long-term investors because in a way it defines your entry exit points. It's also helpful in monitoring supply and demand. Unlike the other three charts where time was also equally important, the point and fingers chart do not take into consideration time. It only tells you the buying point and the selling point. Uh, let's have a look here. This is the line chart. Okay, this is the line chart. Can you confirm these images are very clear to you? Can I get some confirmation, please? So this is what a line chart captures. So let's say this is a the line chart of the closing prices. So you can see for yourself what happened to this particular underlying over this 6-7 months period. But it does not tell you so much about what happened during the course of the day. Let's go to the next one, which is the bar chart. The bar chart tells you about where the stock has opened, the high of the day, the close of the day, and where the stock has closed. So at least in that respect, it is slightly better than the line chart. The next is the candlestick. Uh, Candlestick is the most widely used technical indicator, I mean, the chart anywhere in the world. So just let me try to show you one. For example, this is a red candle. So what it tells you here is the prices opened here, it made a high here, it made a low here, and it closed here. So that is why the candle is red. And so what I will do is if just show you an actual charting software. Just bear with me for a moment. So that will be much more easier to understand. Are you able to see this screen? Can you confirm? This is a charting screen.
Yes, sir, it is visible.
Okay. So this is a green candle. What it indicates is the prices opened here. It made a high here. Okay. Uh, this is where it closed. So this is the opening price. This is the low of the day. This is the high of the day. And this is the closing price. Let me go to a red candle. So what it tells is this is where the price opened. It made a high. You can see a very, very small tail here. This is the low of the day, and this is where the price closed. So this is how you read a candle. So let me go back to the original one. And finally, you have the point and finger. So as I mentioned earlier, there is no x-axis here which tells you the time. So time is not plotted. The x tells you that the prices are going up, and the circle tells you the prices are going down. It is used by some of the traders, but then it is not as easy to understand as the Japanese candlestick. So you will not find too many people using this. Uh, we normally use two scales. So one is a linear scale and the other is a log scale. So the linear scale actually captures the price difference, uh, you know, at predetermined and fixed interval. I'll again show you with an actual chart. So it captures an arithmetic progression, whereas the log scale will capture in terms of a percentage change. Uh, for a long-term chart, if you want to study a long-term chart, it is better that you look at the log scale rather than the linear scale. I'll just tell you how it looks like. Just give me a moment, please. So this is a chart of ICICI Bank over a 7-8 months period. This is a log scale. If I were to represent the same in terms of a linear scale, this is how it would look like. Let me take a slightly longer term one. So this is Infosys on the linear scale. If I were to take a log scale, it would look like this. Let me show you some more. So this is about a 2-year chart, uh, about 1.5 year charts on Nifty. This is how it looks on the log scale, and this is how it would look on the linear scale. So if you're looking at really long-term charts, the log scale is preferable to the linear scale. Okay, so let me come back to my original screen. So we are going to delve a little deeper into the Japanese candlestick. It evolved in Japan way back in the 1700s. Developed, the credit to this goes to a Japanese rice trader by the name of Munehisa Homa. He was the one who is supposed to have invented this type of a trading. So during those days, almost 300 years back, they there used to be trading in rice in Japan in the Osaka Stock Exchange. So the link between the price and demand and supply of rice uh, was captured by the traders using this methodology, because just like today, even during those days, people realized that in the short term, prices are run more, by emotions, than on any fundamental factors. So let me try to show you this candlestick. So this is a bearish candlestick. What does it mean? The price opened here. Okay. It made a high for the day. So this is a daily candle. You can have it for any periodicity. So you can have an hourly candle. You can have an half-hour candle. You can have a weekly candle. You can have a monthly candle. So this, let's say, is a daily candle. So this is where the price opened. This was the high of the day. This was the low of the day, and this is where it finally closed. Because the closing price is lower than the opening price, the shape, I mean, the color of the candle is red. So this is the body of the candle. This is where most of the price action was concentrated during the day. These two are the sometimes called as the wick or the tail of the candle. So this indicates extreme ranges for the day. Slightly different from this is the bullish candle. In the bullish candle, this is where the price opened. This was the low of the day. This was the high of the day, and this is where the price is closed. Because the closing price is higher than the opening price, it is a green candle. So this is how it has to be read. Now you would have understood what I'm trying to say. The Japanese candle gives you a lot of information as to what happened during the day. Let's have a look at some single candlestick pattern, and then we will have a look at two candlesticks and three candlesticks as to how do you read that, or what is the meaning of that, and does it tell you anything about the direction of the market? Is the market continuing in the same manner, or is there a trend reversal? Somewhere around the corner. Let's have a look. So here the trader looks at just a single day's price action. And if he gets his pattern right, the trade can be very, very profitable. Important thing is the length of the candle. Length of the candle should not be short because it does not tell you anything. All right. It only tells you that trading during the day was lackluster, it was subdued, there was not much buying or selling interest. So the length of the candle has to be significant. Uh, the first one that we are going to discuss today is the Marubozu. Marubozu in the Japanese language would mean bar. So basically, what is a Marubozu? It is a candle which does not have any tail. So you can see here, I will explain both the Marubozus here. This is a bullish Marubozu. A Marubozu can happen anytime. It can happen in an upwardly trending market. It can happen in a downwardly trending market. It can happen in a sideways market. But the significance of a Marubozu, for example, the markets are downwardly trending, and suddenly you get a candle like this, okay, where the opening price is the low of the day and the closing price is the high of the day. What it means is probably the sentiments have changed in the market. So a lot of traders give importance to this candle. You can come to a view just by looking at the price action for a single day. So you do not need a prior trend to trade the Marubozu. So a green candle tells you that this is probably the time to go long on the market with the stop loss of this level, which was the low of the day. And this is a bearish Marubozu. It can happen anytime. It can happen in a upwardly trending market. It can happen in a downwardly trending market, even in a sideways market. But a bearish Marubozu like this. And the important thing is this pattern, did it happen along with the volumes? If it happens with the volumes, then it should be considered significant. This is an indication that probably the mood is changing in the market, and traders are likely to trade on the negative side or on the bearish side. So if you are planning to go short in the market, this is a good candle. You can short the market with the open high as a stop loss, right? So these are uh, the two ways in which the Maru Bozu can be interpreted. Some traders will look for further confirmation. They will look for how the markets are opening or closing tomorrow. So they will wait for one more day off. So the mind has been made up. So the trader who wants to trade the market knows that this is a time for me to go long. Some of them will take the trade on the same day. Some of them will wait for one more confirmation. Some few things about Marubozu. If the candle is very small, then it should not be considered significant, and one can avoid that Marubozu. And similarly, if the candle is very long, for example, the candle is in the range of 8 to 10%, then what happens is the trade becomes risky because your stop loss is very far away from where you would be initiating the trade. So an ideal Marubozu to trade would be about a 4 to 5% type of a candle. Okay. Uh, Next comes the spinning top. A spinning top will have a small body, like my cursor is what I'm showing you over here, and it will have long tails or long shadows. So a spinning top can happen after a trend. So suppose the market is in an uptrend, and then you get the spinning top. So this is giving you an early signal that the market is not looking so good. And similarly, if you get a spinning top when the market is already trending downwards, it is again giving you an early indication that the bears are trying to take the market downwards, but they are not successful. So the red candle, for example, shows the failure of the bears, and the green candle shows the failure of the bulls. Uh, Again, in isolation, it may not mean too much. So you will have to wait for one more days of additional confirmation. So immediately after the spinning top, next day the market opened downwards. Then basically your original the view is now getting confirmed. The next comes the doji. The doji is very similar to a spinning top, except for the fact that it does not have a long body. It has a very thin body. Doji indicates indecisiveness. You will get a doji somewhere near the market top, so which it is telling you that the bulls are not very confident about the markets going up. That is, if you get a doji at market top. And similarly, if you get a doji near the market bottom, it is also telling you the bears are now no longer comfortable of taking the market downwards. So doji in a way indicates indecisiveness on the part of the dominant player. How do you read a doji? Normally, the opening price and the closing prices are equal. So this is the small body in a way tells you that the major players are not very sure. They are indecisive about the direction of the market. Uh, the doji, just like the spinning top, it has similar in implication. If a doji happens at a market top, then in all likelihood the markets could correct from there. And if a doji happens near the market bottom, in all likelihood, the market may reverse its downwards trend from there and start moving up. Let's have a look at the hanging man. So a hanging man is a bearish reversal pattern which will occur after the prices have continuously gone up. It can be a small hanging man or it could be a large hanging man. But the essential precondition is that there has to be some 5, 6, bars where the price is going up, and then the hanging man occurs, uh, a hanging man will have a small body and it will have a long tail or a long shadow, which should at least be twice the size of the real body. And on the upper side, there will be no tail or no upper shadow. So I'll show you just a minute. I'll show you how a hanging man looks like. So how do you read this? In the this pattern, the markets are going up. The bulls are trying to take the markets further up, but then suddenly selling emerges at the top. The bulls are no longer able to push the market upwards because now the sellers are becoming more powerful. And that is how this shape materializes. It is just an early signal or an early warning to those who are trading long that be careful. The bulls are finding it difficult to take the market upwards. Most professional traders will wait for a confirmation on the next day. So a hanging man has to be followed by a bearish candle on the next day for the hanging man pattern to get confirmed. So I'll just show you the pattern. So this is how a hanging man looks like. So there has been an uptrend. The markets are going up. The bulls are trying to take the market upwards. They are meeting with resistance here. Okay, and this pattern emerges. Now, by itself, it may not be a confirmation that the market is going to change direction. So typically what most professional traders will do is they will wait for the confirmation the next day. Now this is a clear-cut indication that this is a confirmation of uh, the hanging man pattern that the bulls are unable to take the markets upwards. The market has now come in control of the bears and they're trying to push it downwards. So you can take a trade here with the stop loss of the hanging man top and stay on the trade. Similar to the hanging man would be a hammer, just like how a hanging man occurs at the uh, top of the price chart. The hammer will often happen after there is a steep decline in the stock prices. Uh, Hammers also have a small real body and they have a lower shadow which occurs after a price decline. So basically, how do you read this? The sellers are trying to push the market downwards, but now suddenly fresh buying is emerging, at the bottom, and the sellers are no longer, the buyers are no longer able to push the price downwards. So that is how the pattern materializes. The close can be above or below the open, although the close should be near the open for the real body to remain small. So just like in the hanging man, in the hammer, the real body is small and the tail or the shadow should be roughly twice the the length of the real body. The hammer is an early indication that the bears are losing steam and the bulls are ready to now, take the market upwards. But just like what I mentioned for the hanging man, professional traders will wait for the confirmation. They will wait for one more day before taking the trade. So if the next day's candlestick pattern is confirming bullishness, you can go long on the next day by taking the stop loss of the hanging man. Uh, so I'll just show you. This is how the hammer pattern looks like. The prices are declining. The prices are declining. And here is where the hammer emerges. The bears are trying to push the price downwards. They are not able to, they are not very successful because fresh buying is emerging here. And this is how then the pattern happens. The hammer is giving an indication that probably a trend reversal is around the corner. So what traders will do is wait for one more day to get the confirmation. So this is a bullish candlestick. So what most traders will do is go long here with the stop loss of the close of the hammer. So this is how the hammer pattern looks like. The next would be someone has asked, we'll have to know if you tell this candle in the market charts. And so I think it was YV. Uh, After I close this session, I'll give you some few actual charts where these patterns have emerged. So the next is the bullish engulfing pattern. Uh, so this happens when the prices, they continue to fall, and suddenly near the bottom, you see a candlestick which is engulfing the previous day's bearish candle. Okay, it completely overlaps the previous day's bearish candle. Uh, it is just like the earlier uh, candlestick pattern which I mentioned. This is also a trend reversal, or most likely the beginning of a trend reversal. So, how does it look like? There is a series of new lows which the markets are making, and suddenly you have a bullish engulfing pattern, right? Uh, Again, investors or traders will look for confirmation if they want to play it a little safe. So let me show you how it looks like. So this is how the prices have behaved. The markets are in a downward pressure, and suddenly you see this candle. Okay, why do we call it the bullish engulfing? Because this was the previous day's candle. So near the low of the entire price range, we see a candle which is completely engulfed the previous day's candle. Okay, so this is giving you an early sign that a trend reversal is very much on the cards, and subsequently you can see for yourself how the markets have behaved. Okay, we now go to the next one, which is a bearish engulfing pattern. This is exactly similar as the earlier one, but in the opposite direction. It can occur in anywhere, but if it happens near the market top, it is definitely significant because it is telling you that the bulls are losing steam and the market is coming under, in the under the control of the bearish players. So the engulfing candle has to, I mean, the bearish engulfing candle, which you get at the top, it has to completely engulf the bullish candle. That is very important. And then probably if you want to play it safe, you can wait for a day more to get that confirmation. So I'll show you how a bearish engulfing candle looks like. Okay. So this is how the markets have behaved. The prices have kept on going up, and suddenly near the market top, you see this. Okay, this is a bearish engulfing candle. It has completely engulfed the earlier day's bullish candle. Means what is the meaning of this? It opened here, it made a high here, but fresh selling emerged around these levels. So the bulls were not able to take the markets higher, and finally they gave up, and this is how the price behaved. So it has closed here, which is very much near to the low of the day, and this is how the candle looks like. Some traders will be comfortable trading here. Few traders may look for confirmation here. So here what has happened is, though the markets were slightly bullish, but it was not even able to reach the middle side, I mean the middle portion of this candle. So this is a classic uh, pattern where you can go short on the market. Let's have a look at few more candles, and this is the dark cloud cover pattern. It is a two candlestick pattern. It can occur after an uptrend or very near to the top of the congestion area. So the prices are going up. We are in a bullish trend. So each candle is making a newer high compared to yesterday's candle. And then suddenly you have a dark cloud cover pattern. So I'll show you how it looks like. You see, this is how the prices have behaved. Okay, the prices are going up, and suddenly you see a dark cloud cover. So how do you identify this? In a dark cloud cover, the prices open up. It goes further up, but it is not able to sustain, and it closes somewhere near the midpoint or lower of the previous day. When you have a pattern like this is now giving you an early signal that the markets are most likely to be topping out. So this is how a dark cloud cover looks like. Okay, you can wait for a confirmation the next day because the market looked to be bullish. It was trying to go up, but it could not sustain. So the market becomes a great short here. Okay, by keeping this as the stop loss. The next is the piercing pattern. It is exactly the same as the dark cloud cover, but in the opposite direction, which means you have a series of new lows happening. The markets are continuously going down, and suddenly you see a piercing pattern, and your white candlestick follows a red candlestick with a significant gap in the red candlestick close and the white candlestick open. So this again gives you an early signal that there could be a trend reversal on the cards. The bears tried to take the market downwards, but they were not successful. So let me show you this. This is the piercing pattern. The market is under pressure. The prices are continuously going down. And what you see here is the markets opened here. So this is almost like a Maruguzo, but it could not go further down. And finally, the closing was more than half of the previous day's candle. So this is a piercing pattern, chart pattern. This is now giving you an early indication that there probably could be a trend reversal on the cards. And this is how the prices behaved further on. So both piercing pattern and a dark cloud cover pattern, they are almost the same, but in the opposite direction. You'll get a dark cloud cover pattern normally near the top of the markets, and you will get the piercing pattern normally near the bottom of the markets. This is a morning star pattern. Uh, so we go one step ahead. What we began was with a single candlestick. Then we try to analyze two candlesticks. And now what we will do is we'll have a look at three candlesticks, and one of which is a morning star pattern. So I'll just explain what it is. It contains three candles, and it is generally interpreted as a bullish signal. So first you have, as the market is coming down, you have a tall candle, and then on the next day you have a smaller candle with a short body, and on the third day you have a tall candle. Okay, so the middle candle uh, of these three candlestick, it captures indecisiveness on the part of the bears. The bears are now sort of beginning to give way to the bulls. The third candle will confirm the reversal and can probably mark a new uptrend. uh, the opposite of this would be the evening star, which signals a trend reversal of an uptrend. So let's have a look at the morning star. How does it look like? So this is what the morning star is all about. You see the markets coming down. Okay, the markets are making fresh lows, and suddenly you have a candle here, which is a moment of indecisiveness. By itself, it does not mean anything. But what is happening over here is the market refuses to go down. So you read all the three candles together. Okay, the red candle, which is a bearish candle, followed by a very small candle where the bears are unable to take the market downwards. And suddenly, and then on the third day, you have a candle where the closing is more than 50% of this one. Okay, so it is above 50% of this one. So this is a sign of a trend reversal. And this is where traders who wish to go long on the market can consider doing so. Evening star pattern, almost the similar to the morning star pattern, and this would happen at near to the market top. You will have three candles. As the market keeps on going up, you will have a long candle, a bullish long candle, followed by a very small candle, which indicates a moment of indecisiveness, then followed by a tall red candle. All the three have to be red together. So this is how it looks like, the evening star. Okay, so this is how the prices keeps on going up. And then you have a small candle, a candle with a small body. This tells you a moment of indecisiveness, and this is followed by a tall red candle. So these three candles have to be read together, and traders will definitely go short on the market on this candle. This is a triangle. A triangle is generally a short or a brief period in the market where the market consolidates. Okay, the market consolidates, and then it will either break down, or it will break out. So if you see here, what is happening here is the market has seen large moves, and then you see volatility coming down, volatility consolidating, and a time comes when the volatility is so low in the market that the market will either break out or it will break down. So this is a case of a symmetrical triangle where the initially in the aftermath of the huge variation in prices, the prices went on consolidating, and it somewhere over here it broke out. So breakout from the upper side of the triangle is considered a very good bullish signal. And similarly, you have the ascending triangular pattern where the market keeps on making higher lows and the same level highs. Uh, we generally see this in an uptrend, and most traders will say that this is a continuation pattern as the buyers are becoming more and more powerful. So if it breaks at the top of the pattern, most of the traders will take a long trade. And similarly, if it breaks below the lower trend line, it is a good time to go short in the market. So this is how it looks like. Okay, if you see here, this is how the price behaves. The price is fluctuating, but on the upper side, there is a resistance. So on the upper side, the prices are retracing from the same level, but here the market is making a higher low each time. So in other words, that it's an ascending triangle. And when it breaks out from here, it is considered as a very good sign. Finally, the descending triangle is exactly the opposite of this. If you see here, the prices are taking support on this flat line, whereas it is not, it's making a lower high each time. So there is a high chance of the prices breaking down, then breaking out from here. And eventually this is what happened. Okay, so you see here the price breaking down. Finally, we have flags and pennants, which what happens after a large move, the market takes a breather. It consolidates for some time and then it resumes its upward journey, and that is what your flags capture. Okay, some few important pearls of wisdom. Uh, Financial markets suffer from a deep inability to price patience and compounding because of their dominant short termism. Okay. In fact, we all know that if you invest in good companies over a long period of time, can potentially make a lot of money. But then what is actually happening in the market is uh, trading has become very, very short term in nature. And that is how it is. The art of investment is a discipline of inaction in the absence of a good opportunity, but aggressive action when one is identified. So, if you don't have any opportunity, ideally one should stay away. But when the opportunities are very good, one should become very, very aggressive. One more piece of wisdom: inaction and patience are almost always the wisest options for the investors in the stock market. Uh, this is really thought provoking. You make 80% of your money in 20% of the time, and the rest of the time you just have to be patient. Uh, this is actually very true, but it does not happen like that. And probably one of the most famous sayings in this market: far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in the corrections themselves. Okay. Peter Lynch, one of the greatest fund managers of all time. So at his peak in the 80s and 90s, he was managing the biggest mutual fund in the world. Okay. So that's it from my side. Let me see. Yeah, yeah, I will definitely provide the PPT. I'll give it to Neha ma'am, and she will make it available to all of you. Okay, so I am open to questions if any. And in the meantime, let me see if I can show you some of the chat patterns. Neha ma'am, just give me 5 minutes. I can show them the actual chart patterns. So,
Yes.
uh, can you see a Marubuzo here? This is how a Marubuzo looks like. Uh, I'm open to questions. If you want to see any particular pattern, so let me see if I can show you the hanging man. Yes, if okay, so you can see the hanging man here. And this was what was called as the piercing pattern. When the bears try to take the market downwards, you had a moment of indecisiveness. You can see a hammer here. Okay, the markets went up, and this is where they tried to take it up, but they were not very successful. And from there on, so this was a very nice trading shot. Okay, yeah, I'm open to questions. Uh, so someone has asked, when do you use the daily, weekly, hourly chart? So each one of the trader has its own preference. If you're doing short-term trading, the hourly chart is very good. But if you're using charts for a long-term investment, then definitely the weekly chart and the monthly chart will be much more useful than looking at the uh, short-term charts. Someone has asked, how good is technicals versus fundamentals? Both are completely different way of looking at the price. I personally know a lot of guys who are very good in technicals, who have done very good for themselves, and I also know a lot of guys who are very good in fundamentals. Finally, it's your own individual preference. But if you're able to mix it nicely, fundamentals tells you the story behind why a stock is likely to perform, and the technicals will help you in entering the market at the right time. Someone has asked, the chart patterns that you showed are very insightful, but is it reliable as compared to the fundamental analysis? So the basic point here is when you trade technicals, you're playing a probability game. So please understand that nothing is 100% you know perfect in this market, including fundamentals. So you are playing the probability game. So you would be right some of the times and you'll be wrong a lot many times. So when you're trading technicals, more important than the percentage of right trades is how good you are with risk management and money management. Okay, all of us will go wrong, you know, by trading the market using technical analysis. So when you go wrong, you have to admit that you have gone wrong and just exit from the trade. So there is no point in holding on to a losing trade because the consequences could be disastrous. Uh, Someone has asked, how can we determine if a share is a good investment? Finally, a good investment is if their operational performance keeps on improving. So what do I mean by that? If their sales increase, if their operating profits increase, if they're able to protect their margins or improve their margins, and if there is increment at the net level, then definitely you have a good stock in hand. I think that was BA. Someone has, what is BDL? Someone has said, please discuss BDL. So I did not get that question properly. Some of the books that you can refer to is there is one book on technicals by John Murphy. There is a book by Edward Maggie, and there is a book by Martin Pring. All these books are very good books on technicals. There is a book by Mark Minervini, Trade Like a Stock Market Wizard, which is a very good book. There is a book by William O'Neill, How to Make Money in the Markets. Both these books, the Mark Minervini book and the William O'Neill book, uh, they use very little of technicals and very little of fundamentals. Okay, so it's a mix of fundamentals and technicals. It is if you're serious about the markets, these are the two books which I would strongly recommend. These are some of the books you can consider reading. You can read that. ST has asked which time frame is best to mark support and resistance. Again, ST, the thing is what type of trading you are doing. If you're a short-term trader, then the hourly time frame is good enough. Otherwise, at the most, you can use the daily time frame. Technical analysis will always be relevant, CA, even with AI. Because basically what you're trying to do is capture the psychology of the market, and the charts tells you everything about the psychology of the market.
So I would like to thank our esteemed speaker for the very insightful session. Thank you
Thank
so
you,
much
ma'am.
for your participation and engagement. So officially, I close the webinar here. Stay connected with us for future webinar. Thank you. Have a great evening.
Thank you.